All right, good morning, everyone. It is 8:51 on the morning of January 24th, 2023, and this is my pre-market strategy session. And so today, what the deal is well, the NASDAQ, or I should say actually the Qs are a proxy for the NASDAQ. The Qs came up and definitely repaired the gap that was in the chart that I was looking at yesterday. I was expecting it to be a bullish day, and I was quite surprised at how bullish it was, actually. So here's the gap. This gap was put in between the 14th and the 15th of December. So we got a close here at 286.51 on the 14th of December, and then it opened again here at 282.33 on the 15th of December. And so there was a gap there. So then about a couple weeks after that, there was a support that was found down here between the 28th of December and the 6th of January. And then it broke out to the upside. And this is, pretty common here. Let's see. Let me look at this here real quick. So usually what you'll get is, this move down right here, some consolidation, and then continuation on the move down, right? In a bear market. I mean, really, it happens really quite often. That's the way it goes, right? But we had gotten into a point here where it was in this price zone again, only about a month or two prior to that, in this price zone again about a month prior to that one. So this was the third time. One, two, and then this over here is the third time we were in this price zone. And it was three strikes you're out. The bears couldn't pull it off after three tries of breaking down below these price levels right here. And so it goes up, after, so long. There are only so many sellers that come to the market, and the sellers, for the short term at least, are exhausted right now. And so now we explore prices to the upside. So this is what's going on the upside here, the way I see things. We've got some top resistance here. This red line, this top red line right here. And we've cleared the gap. And so what I'm guessing is going to happen is that we're going to bobble around in this price area over here again. Let's see, we're over here for a short period of time, then again just a few days later to the upside, and then again to the upside. Three strikes you're out. Couldn't make it higher, it goes lower. Three strikes you're out on the bottom side here. This whole thing, call this 1, 2, and then 3. You're out. Now we explore to the upside. Okay, so there's quite a bit right in this area as far as resistance goes. We are sort of in a resistance zone, right? And I wouldn't be surprised to see things move sideways for a little bit, for a couple of days at least. And then we do one of two things. We drift sideways a little bit and break out, or drift sideways a little bit and break down. Now, I am in the camp, it's my opinion, that when the market is trying to make up its mind, or there's sort of, you can't really tell which way things are going, the best default is to the upside. When history, if you go back and you look at these markets, history favors the bulls. It just does. And look at this, bottom right to top left, right? And so things did definitely get carried away. Now I could put this on a log chart so it looks a little bit, flattens it out a bit. You know, it's more appropriate right there. But yeah, you know, it's bullish. Being long is just a lot easier than being short. You know, being long is just the way that it works. You know, people keep buying. The steady buyers, the philosophy of time in the market, not timing the market, right? Yeah. So those who are in the market the longest don't necessarily do the best. There are people, you know, that it can beat the market returns, you know, on a consistent basis. It does exist, definitely. It does exist. It's just that you know, if you're not a sophisticated trader and investor and so on and so on, and you know you're tucking away money every month for your 401k, you know, and you're getting a company contribution and stuff, that's just consistent buying in the market, time in the market, not timing the market. So the default is bullish, right? So here we are. You know, we get to find out. We are forecast to be in sort of detrimental economic conditions for the next roughly 5 to 6 months. And then also, there are a couple things looming. We've got the 10-year, 2-year inversion, which it is now. So here's the 10-year, 2-year inversion. This yellow line represents the sort of record low that put back in, I think it was 2001. Let me go to the monthly here. Yeah, the 2000 leading up to the 2001.com crash was the low at negative 699 basis points. And we've spent a few days, couple of weeks, I think, actually, you know, yeah, went down below it, popped back up above it, and now here we are kind of consolidating the 10-year, 2-year split. The 10-year, 2-year inversion is kind of back down and below the 699 level again. And 899 was a record level put in at some point during the pre-market. It doesn't show it on this chart, but it happened. And so, yeah, it looks like, to me personally, I think things are about to head back down again. Now, a deepening yield curve inversion is definitely forecasting a recession. And the longer it stays inverted and the further down it goes, the worse the upcoming recession and corresponding downturn in the market is supposed to be. So we're headed for some kind of a doozy down move in the market. But if you look back during the inversion, let me go to the monthly again, is that during this inversion back here in the early 90s, the yield curve inverted and the markets did fine all the way up until when the yield curve normalized again. Again, in 2001, leading up to the 2001 .com bubble, while the yield curve was inverted, all through this time up until like the last month or two, you know, the Qs, the QQQ was headed up. It was going up. Same thing before the 2008 housing crash right here. The markets, the S&P, the Qs, you name it, the Dow, everything was headed up until right before you get the peak, you get the top in the market right there before the tail end of the inversion normalizing again, and then things start to roll over. You'll see the top like a month or two before the inversion normalizes again. And so here we are. And so this inversion back here in the late 90s was roughly, you can see it kind of popped up above the inversion mark again, above zero there. That lasted about 18 months. The 2001.com bubble lasted about 12 months, and the 2008 housing crash inversion lasted about 12 months roughly. And so we are going 5 months now into inversion. So 7 months. 1, 2, 3, 4, 5, 6. We're in the 7th month of inversion. and things can stay bullish during this inversion time right here. Things can be bullish. It's only after you get up to here where things are going to normalize again, and it normalizes, and that's when the crash. That's when you see the effect on the equity markets. All right. So what's happening right now with the? Hang on a second. I'm gonna need to pause for just a second. All right. Be quiet. Get out of here. Be quiet, both of you. Get out of here. I love you. All right. Sorry. No, son. Sorry about that. The default direction is bullish, and we'll see in another somewhere around 5 months to 11 months roughly of what things turn into here, and how things turn out. So yeah, let's take a look around here real quick. So the 10-year, the 2-year is moving up a little bit this morning in the pre-market, or actually it's regular bond market hours right now. And then the 10-year is trying to climb up a bit this morning, but it's down. So when the 10-year is going, the yield is going down, and the 2-year yield is going up. That creates a greater inversion, and that's why we're seeing this dip down today right here. This little, I don't know if you can see it or not, there's this little tiny red, almost a doji right here this morning. And so let's see then what else. 10 years, so there's the 10-year. Bitcoin has just made this really surprising move. I think it's going to be short-lived, and I think after whatever has caused this run up right here, it's going to come back down. But Bitcoin's been a great leading indicator. And really, how much further out in risk can you get than, a cryptocurrency? How much more risky does it get? This thing is, based solely on what people see in its value. And so, it's my opinion, that we come back down to this red line again before we see the bottom in Bitcoin. Although this move above 19,000 right here is very encouraging. This 19,000 move right here corresponds to really two spots. It was the peak back here in 2017, and then over here, I think it was in 2020. Yeah, late 2020. You can see this price level again right here before a major breakout to the upside. The price of Bitcoin came back and tested this area, then broke out big time right through there. So right now, Bitcoin has recovered this base price again. And I'm not saying it's smooth sailing for Bitcoin to run higher at all, but by any means do I think that it's time for Bitcoin to run higher, actually. Pardon me. It's actually my opinion. This gigantic distribution pattern right here that finished off with the head and shoulders is just the way it's going to go for, it could be 5 to 10 years, in my personal opinion. I could be wrong. I'm very pessimistic about cryptocurrencies, but Bitcoin really does seem to be a shining star among the cryptocurrency sort of field. All right, then next up, something really encouraging here actually is this is natural gas, and so Russia, the invasion of Ukraine, the so on. There's a lot of speculation that occurred in this pattern right here. And actually, this is actually a really good example of a Wyckoff distribution right here. So it went into distribution, and typically what happens after you see a big distribution like that is prices just settle back out again. Let me kind of get this to where you can see it settle back out again and just kind of continue a long, slow, steady drift. Natural gas isn't a commodity you want to see big price spikes in. Usually means there's some kind of a supply chain issue, geopolitical issue, and we had both of those at the same time. Supply chain issues and geopolitical issues, which really caused natural gas and a lot of commodities to kind of go, haywire right here. It looks like things are starting to settle down again. Doesn't mean that we won't see another leg up, but it's good to see, definitely good to see natural gas come down again. And actually, I want to pull up natural gas and look at the comparison here. Natural gas, I think, is going to be a leading indicator to gold. In my opinion, I think this right here it's one hell of a rally, no doubt. But I think that it's just a matter of time until this rolls over, until this pattern rolls over, and it starts heading back down again. The distribution, the main distribution in the price of gold has already happened back here with these two peaks, quite similar to the way natural gas had its two peaks. Then we get somewhat, I don't want to call it a sucker's rally, but we get this, sort of late after the peak rally that gets sold into and just keeps getting sold, sort of the way it looks to me that gold is stacking up. So we ought to see a reversal in gold here pretty soon, in my opinion. So that's the way I'm seeing things right now. The default is bullish. Of course, just trade the chart that's in front of you, whatever your strategy is. But know what your bias is, and I'll know what my bias. I know what my bias is. My bias is bullish, and so I know whether to go against my bias or to trade with my bias, and that's a big, that's a big way to be able to identify whether you're moving. If you go back and you look at your notes and you have at least your bias written down, and whether you're with it or against it, and what the setup was that you're using, it's just an analytic, and so it'll help you trading. All right, everybody, good luck out there. Keep your risk tight. Click like, share, subscribe, leave a comment, tap the bell, and I'll see you at tomorrow morning's strategy session. I am out.